Have you ever been at a basketball game getting a hot dog and suddenly there's a roar from the crowd? You instantly think to yourself, what if I just missed? Something big has just happened. A price chart may not make noise, but it has another mechanism to let you know there is something happening, something to pay attention to, and that mechanism is bar volume. While much of technical analysis focuses on price action, volume analysis is almost as important when it comes to understanding market trends. In the futures market, volume refers to the number of contracts traded. You can think of volume as a sort of vote for the direction of the trend a trader has for that market. When a trader places an order to buy, the size of the order might reveal that trader's conviction or confidence in the trade. Analyzing the aggregation of volume in different ways can help you understand what the market participants think about the current trend or price level. The basic volume study is shown as a histogram chart, usually underneath a price chart. These bars represent the number of contracts traded for each time interval in that chart. One way to interpret this chart is to compare volume to previous bar's volume. If the volume is increasing, that shows that the trend could be reflective of where the participants think the market should go, regardless of if the move is up or down. If there is a price move of weakening volume, this might indicate a false move, and you might anticipate a return to the previous trend. Another way you can look at volume is through the filter of price. The volume profile study displays a histogram chart with the price axis acting as the base. The volume profile is created by recording how many contracts traded at a certain price or price range. As the trading day unfolds, you get a sense of which price levels had the most activity, which can be used to identify areas of support and resistance. This is especially useful for the futures trader on an intraday chart. The shape of the profile chart can be compared to a bell curve, with the idea that 68 to 70% of all trades happen around the most traded price area. Volume-weighted average price, or VWAP as it is known, combines volume and price information to create a set of lines that can be useful in identifying areas of support and resistance. VWAP is calculated by multiplying price by volume for each trade, summing those results up, and dividing by the number of contracts traded. This results in a value that gives more weight to the trades that are bigger. VWAP can be used as support or resistance, and even as a magnet that the market tries to return to during the trading day.